Okay, so welcome back to our series on international taxation concepts under the New Income Tax Act and the new income tax rules. So, guys, in the first video, we set up the foundation. We discussed the concepts of residence, scope of total income, double taxation relief, foreign tax credit, and transfer pricing, APA, safe harbor framework, etc. So in the second video, we added the treaty layer in those concepts. We discussed the concept of permanent establishment, profit attribution, limitation of benefits clause, GAR provisions, MAP provisions, country by country reporting. Now in this third video, I want to move from pure concepts to practice. So we will walk through 10 case study style concepts here, applying these provisions to real life fact patterns, things like service p versus independent agent, construction p, digital significant economic presence, indirect transfers, foreign tax credit, gar versus lob provisions, cbc reporting, etc. So let's start with concept number 21. We have already discussed 10 concepts in our first video and another 10 concepts in our second video. So now this is the concept number 21. So let's start with the service P, and how it differs from dealing through an independent agent. So guys, under most of the India's DTs AA, there is a specific clause that creates a service P where an enterprise furnishes services through employees within India for more than a specified number of days in a 12-month period. So at a domestic level, section 9 deems income of a non-resident to accrue or arise in India where there is a business connection, and the explanations bring independent agent situations very similar to agency PE concepts. So in practical terms, if a foreign consulting firm sends its own employees to India and they stay beyond the service PE threshold, India can treat that as a PE, and tax the profits attributable to those Indian activities under the business connection rule and the treaty. However, if the same foreign firm appoints a genuinely independent Indian firm on a kind of principal to principal basis, so I mean with no authority to bind the foreign firm and bearing its own entrepreneurial risk, so that Indian firm is taxed in India on its own business profits, and the foreign firms may avoid having a P here. So this is a very important concept, guys. So like if we see an example here, imagine a US consulting company that deploys a team to India for a say 9 months period for ERP implementation project. So under a typical treaty where service fee is triggered beyond 183 days, this would create a service fee and India can tax the attributable profits. Instead of this, if the US company subcontracts the entire project to an Indian independent consultancy, which signs the Indian client contracts in its own name and bear the delivery risk, and so the Indian consultancy is taxed there, but the US company may stay outside the PNet. So this is the concept of service P and independent P. Now let's move to our next concepts. Let us take a classic construction P situation and see, what happens when contracts are artificially split. So guys, many of India's DTAA say that a building site or a construction site installation or assembly project, constitutes a P only if it lasts more than a specified duration. The duration may be maybe say 6 months or 9 months or 12 months, depending upon the independent DTAAs. So section 9 simultaneously treats income as deemed to accrue in India where there is a business connection through such activities. Now, what sometimes happens in practice is that a foreign, construction group or a foreign engineering group splits a single long project into multiple contracts. For example, civil work, installation and commissioning, each assigned to different group entities, each, just below the threshold limit. So the tax administration will look at substance, guys. They will see, are these contracts really independent, or one integrated project being fragmented on paper? If they are really one project, the combined duration can be taken. A construction P can be recognized there, and a GAR provisions under section 178 to 184 can be invoked to, you know, disregard the artificial splitting, because the main objective here is to obtain a tax benefit, undue benefits, I would say. So, guys, uh, now, the crux of the matter is, don't rely on cosmetic contract splitting. So in the new regime, both the business connection definitions and the GAR empower the government to look through such structures and, tax the true economic presence in India. So this is a very, very important concept. I hope it is clear to all of you. Let's try to move to next concept, number 23. So no, so let's get into the digital economy significant economic presence, or SEP. So as you all know that, explanation to section 9 expands the uh, business connection to include significant economic presence as well of a non-resident in India, even without a traditional physical presence. The significant economic presence can arise through transactions in respect of goods or services or property carried out with the Indian users, or through systematic and continuous, soliciting of business activities or interaction with such users, subject to monetary thresholds. And it can also be, the significant economic presence can also be emerged under the user number thresholds to be prescribed in the rules. So in practice, this targets business models where large revenues are earned from Indian users via digital platforms, and also where, the data and the user participation are central, but there is no physical office or a dependent agent in India. So guys, if you see a small illustration here, a foreign streaming platform here has no office or servers in India, but has a few million paying subscribers here. So it clearly crosses the monetary and user based significant economic presence threshold notified in the rules. So under the domestic law, this is a business connection, and income attributable to the significant economic presence can be taxed in India, uh, where, where there is also an applicable DTAA that has not yet updated, and that does not include the significant economic presence. So we need to carefully analyze whether the treaty still requires a traditional PE for taxation of the business profits, and how unilateral measures, GAR and future multilateral instruments may impact this balance. So this is a kind of good case study on the digital significant economic presence. So now we are looking at our concept number 24. The fourth concept is basically, is the one we see in almost every international tax file. Is a payment, royalty. Is it a kind of fees for technical services, or is it something else? So guys, section 9 contains deeming provisions for both royalty and FTS. For example, consideration for the use of intellectual property, or the right to use intellectual property is treated as royalty basically. And on the other hand, consideration for managerial services, technical services, consultancy services is normally treated as FTS, fees for technical services. So guys, chapter 13 part E basically, as mentioned here, particularly section 207, then provides special provisions for taxation of dividends, royalties and FTS received by foreign companies. So from a practice standpoint here, uh, you know, label in the invoice, does not decide the character. You have to look at the underlying rights and obligations. Also, under many modern treaties or the DTAAs, technical or consultancy services are taxed only if they make available the technical knowledge, experience, skill, or know-how, to the payer. So guys, mere use of the service may not qualify in that case. So if it's an example here, an Indian company pays a foreign vendor for access to a standard cloud-based software on a subscription model. So if the Indian user only accesses functionality over the internet with kind of no right to copy, no right to modify, or no right to commercially exploit the underlying intellectual property. Many treaties and judicial views treat this as a service or a business income, not royalty. However, the domestic law may still treat certain digital or software payments as royalty. So, so the payer often takes a conservative approach for, withholding, and the non-resident may seek treaty relief when filing their return of income, or under maybe, mutual agreement procedure as well. They have that option as well. So guys, we need to see here that how characterization drives the rate, the article of the DTAA, and even the question whether P is needed at all or not. So this is the concept of the royalty and fees for technical service. Let's move to our next concept, which is the indirect transfer of shares. This is a very important concept, guys. So this is an area that has been controversial and is now neatly embedded in section 9 under the new income tax act. So section 9 deems incomes or gains to kind of accrue or rise in India, where a share or interest in a foreign company derives substantially its value from the assets located in India. So this means that a transfer that happens entirely outside India, say for example, shares of a foreign holding company can still be taxed in India if the real value is sitting in Indian assets. The income tax act also contains thresholds and carve outs. So certain small shareholders or internal group reorganizations may not be hit with these provisions, but the core principle is that India can tax indirect transfers of Indian assets through offshore deals. If we see an example here, company X, let's say in company X here, let's say in country A owns 100% of company Y in, let's say, in country B, and Y owns a port or kind of infrastructure assets in India. Now, if X sells the shares of Y to an investor in country C, a third country basically, the entire transaction happens offshore. Company X, company Y, and basically. I mean, all the three people are sitting abroad. But because Y's value is substantially derived from Indian assets, Section 9 can deem a portion of X capital gains to accrue or rise in India, and India can tax that portion subject, of course, subject to any capital gain articles in the relevant DTAAs that may restrict India's taxing rights. So guys, from a planning perspective, one has to check both the domestic indirect transfer rules and the treaty protection, both before structuring such exits. or such deals. So this is the concept of indirect transfer of shares. Let's move to our next concept now. Let's take a practical example of how domestic law and the treaty interact for dividend withholding to a foreign shareholder. So guys, chapter 13 contains special provisions on determination of the tax in certain special cases. Within that, section 207 lays down the tax on dividends, royalty, and FTS in the case of a foreign companies. And other section, I mean sections other than 207 covers specified incomes of non-residents and foreign institutional investors, FIIs. So on top of this, section 159 empowers the government to enter into DTAAs, and it is well accepted that non-resident can choose between the act and the treaty and apply whichever is more beneficial. So if domestic law implies say 20% rate on dividend paid to foreign company, but the relevant DTAAs say that where the foreign company directly holds at least 10% of the capital of the Indian company. So India's tax is limited to 5%. The taxpayer can invoke the TTAA and get the benefit of the lower rate. That is perfectly fine. However, this is subject to conditions. You know, the conditions are the foreign shareholder must be resident in the treaty partner and also be the beneficial owner of the dividend. The next key condition is the LOB clause in the DTAA must be satisfied. And the third condition is GAR should not be triggered by the kind of artificial holding structure that exists only to capture the benefits of the lower treaty rates. So here example can be a holding company with real offices, employees, and the decision making in the treaty country directly holding a significant stake in India and meeting the LOB test. So here a 5% treaty rate is usually defensible in the at the time of withholding tax deduction. So this is our concept number 26. Let's move to the next concept. Foreign tax credit, where so foreign tax credit is where many practical mistakes happens. So a simple numerical case study helps here. So section as mentioned here, section 159 and 160 lay down the basic legal framework for relief from foreign taxation, either via DTAA or via unilateral relief. So, the computational machinery and the documentation are in the income tax rules 2026. Specifically, we have rule 75, which prescribes, additional information and documents to be furnished for claiming relief. We have section 76, which specifically lays down the conditions, the kind of computation methodology and forms as well for claiming foreign tax credit. So in broad term, FTC for a particular source of income in a country is limited to the lower of the foreign tax actually paid on that income and the Indian tax payable on that doubly taxed income. So we have to calculate both these figures, and the lower can be claimed as the benefit. If we see an example here, assume an Indian resident company earns business income of say 100 rupees from country A and pays tax of of rupees 25 there in that country A. The same 100 rupees is also included in its Indian total income and is taxed at 30 rupees in India, based on our slab or the rate structure. So subject to the documentation, such as the foreign tax payment certificates and prescribed statements under Rule 75 and 76, the company gets the foreign tax credit of rupees 25 because that is a foreign tax paid, and is less than the Indian tax of rupees 30. Thus, it pays only 5 rupees in India on that income, ensuring the total tax is 30 rupees, not 55. Here, we need to see that if that foreign tax were, say, 40 rupees, so FTC would still be capped at 30 rupees only. The Indian tax on that income, basically, any excess foreign tax is generally not refundable by India. So in that case, there is a cap of rupees 30 for the benefit of FTC, foreign tax credit. So guys, this is our concept of foreign tax credit. Now let's move to our next concept, which is also a very important concept. Now let's kind of revisit and the anti avoidance, in a kind of more nuanced way. uh, how GAR and the treaty limitation of benefit clauses can both apply in the same structure. So guys, modern DTAAs often have LOB articles that set objective conditions. For example, ownership test, for example, base erosion test, listing requirements in some scenarios, minimum expenditure in the treaty country clause, to make sure only genuine residents get treaty benefits. Separately, our domestic GAR in section 178 to 184 allows the tax administration to declare an arrangement an impermissible avoidance agreement where the main purpose is to obtain a tax benefit and the arrangement leads to misuse of provisions, or lacks, commercial substance, or is carried out in an artificial, or I would say abnormal manner. So the interaction works roughly like this. If a holding company, if a holding company fails the LOB article, you do not even reach GAR. The treaty itself denies the benefits. And in the second case, if the company passes LOB technically but has no real commercial substance, GAR can still be invoked to look through the structure and deny the benefits in that case. If it's an example, a group here routes investments into India through a treaty jurisdiction company that just about meets the expenditure thresholds in the LOB article, but has no real stuff, no independent decision making, and is entirely funded and controlled by entities in non-treaty countries. So on paper it passes LOB, but in substance it is a conduit. So in such case, even though the letter of LOB is satisfied, GAR allows the authorities to kind of treat it as a impermissible avoidance agreement, you know, disregard the conduit in that case, and deny the treaty rates on dividends or capital gains. So this is an extremely important provisions which can be seen in a practical parlance. So let's move to our next concept. Now guys, here let's try to link the country by country reporting to the transfer pricing risk assessments. So section 511 in chapter I think 16, together with the rule 123 and 124, it requires certain multinational groups, with consolidated revenue above a prescribed threshold, to kind of furnish a country by country report and the related information. If we see the rules 123 and 124, 123, it describes the information and documents that Indian constituent entities must maintain. For example, group structure, intangibles, the financing arrangements, etc. Rule 124 prescribes the designated authority, the forms, the revenue threshold in Indian rupees for CBC reporting. So at the same time, section 61 to 173 and Rule 77 to 85 contains the transfer pricing regime, including arm's length pricing methods and detailed, documentation requirements. So from the revenues perspective, CBC country by country gives a high level map of what revenues, profits and taxes are reported across jurisdiction. And when the map shows that entities in lower tax countries with minimum people or assets report very high profits, while entities in high tax countries with substantive operations report, very thin margins or very small margins, that is actually a red flag. So the illustration here talks about, an Indian captive service center reports say 10% of, operating margin, but the group's CBC report shows that the entity in a lower tax jurisdiction with only a handful of staff, books 60% of the global profit. So this mismatch, between the functional substance and the profit allocation, can trigger detailed transfer pricing scrutiny in India, and the authorities may seek to attribute a higher share of profits to the Indian entity unless, justified by a robust or very, strict transfer pricing documentation, safe harbors, or maybe advanced pricing agreements, APAs. So now we are moving to our last concept of today's discussion. So let's finish this video by, stitching. I would say stitching all of this together into one integrated, inbound investment case study. So this is a very very important slide. Assume a foreign parent company, sets up a holding company in a treaty jurisdiction, which in turn holds shares of an Indian operating company. So the Indian company pays royalty in that case for brand and technology, interest on say group loans, and management fees for strategic services. So these are the transactions Indian company uh, has done with that company. So at the same time, the group has people on the ground in India, and there are data driven digital interactions with Indian customers. So to analyze the structure under the new regime, you would systematically go through several sections. For example, section 9, we need to check section 9, to see which income is regarded as accruing or deemed to accrue in India. We also have to see chapter 13, including section 207 and the related provisions, to identify domestic rates of the dividends, royalty and FTS, etc. At the same time, we could also see section 159 and 160 read with the DTAA to determine, whether and how double taxation is relieved through the exemption or the FTC method. We might also have to see section 161 to 173, rule 77 to 85, the transfer pricing provisions. We also might have to see the GAR in section 178 to 184, as we have seen in our, above a few slides. And we also, have to see the LOB article in the DTAA to check whether the treaty jurisdiction holding company has genuine substance or not. We also have to see section 511 read with rule 123 and 124, and the groups country by country reports. So guys, seriously, this is what modern international tax works looks like, under the new income tax act. It is not about memorizing one section in isolation, but about, running a multi-step risk and relief analysis across domestic laws, kind of DTAAs, and the reporting framework. So we all have to see all these sections together. Okay, so let's recap, quickly recap, what we have done in this third video on international taxation. we we took the core concepts from video 1 and video 2, kind of, and applied them to 10 practical case studies in our today's discussion. Service P versus independent agents, we have seen construction P and contract splitting, we have seen. We've also seen the digital significant economic presence, the royalties, FTS, indirect transfer of shares, LOB clause, CBC reporting. So we have seen all these advanced concepts in the form of case studies. So by now, guys, you should have a clear picture of how Section 9, Section 207, 159, 160, transfer pricing code, GAR, LOB, CBC reporting actually plays out in a real world structure, basically, and a sense of how to think like an international tax practitioner, not just an examiner. So, so this is our discussion. So we have seen concept number 21 to 30 in our today's discussion. I will be coming up with more such important and useful videos, guys, on international taxation and also on the other subjects as well. For example, IFRS, for example, domestic tax. But first, let us complete the series of international taxation. So, guys, thank you so much for watching this video. If you are finding this series useful, please like, please share and subscribe, and let me know in the comment section which international tax topic under the new law you want me to cover next.